Hello, everybody, and welcome back to the Mouthy Money podcast. We are coming to our recording today at quite an extraordinary moment, actually. News from across the pond is that Donald Trump has won the US presidency. I believe that is now official. It wasn't quite official earlier this morning. To pick that apart, though, and what that means for a variety of money-related things. I'm joined, as ever, by Chris Tuite, Head of Consumer Finance at MRM. Chris, good morning.
Hi Ed, how you doing?
I'm very well, thank you. We are also very fortunate to be today to be joined for the first portion of this podcast by Althea Spinozzi, who is Head of Fixed Income Strategy at Saxo Bank. Althea, thank you so much for joining us.
Thank you so much for having me here. It's definitely interesting times ahead.
An interesting morning, I think, is to say the least.
Absolutely.
So let's like dive straight into what it means, and we're not looking at the politics today. That's not what interests us. We want to understand. I think Chris and I will talk a little bit more about kind of personal finance for the UK after we've talked to you, Althea. But kicking us off, what has been the kind of the immediate response from in investment terms? What are markets doing and what's happening?
Well, what's happening is that we are seeing an extension of the Trump trade. And what does that mean? It just means that investors are expecting a reduction of taxes, an increase of tariffs that ultimately is going to be inflationary for the economy. So how markets are reacting to those news is basically dumping US treasuries because inflation is the driving factor of fixed income securities. So rising inflation would erode the real value of these securities, and that's why we are seeing yields rising quite fast. And on the other side, investors are trying to weigh the implication of the Trump trade, especially in the equity markets. And we have seen quite a spike in the Russell 2000 and also those stocks that are related to Trump's. And I'm talking about Tesla because of Elon Musk and also DJT, which is the Trump media company. So it's not news. We have seen that kind of trade for quite a few weeks now. But markets is awakening to the fact that this is real. He might have a red sweep and he might implement everything that he promised.
So this is, I mean, what's interesting here, this is it's very much a short-term market noise about what's going on, right? It's readjusting to this kind of new information, the new normal that we've now established is going to be, happening. So in terms of the kind of the longer term, should we expect kind of a little bit things to settle down, and what do you think? How do you see it changing in that respect?
Definitely. First of all, we need him to enter the White House. But before he does that, there is going to be plenty of the speculations because we know that markets love to speculate. So I don't expect volatilities to subside within the end of the year. We are going definitely to have a volatile market that tries to grasp what is going to happen in the next 4 years. And as per our prevision in the case of a Trump win, I expect the 10-year US Treasury yields to move higher and towards 5% by the end of the year, which can have great implications for other asset classes, especially equities at this point in time.
Thinking about those kind of the implications for what ultimately are people's investment portfolios, and in the UK that can be pension funds, ISAs, people's long-term savings here that will to a large extent have a lot of exposure to the US because it's such a big economy. What is the kind of the message there? Do people just need to take this all with a bit of pinch of salt, no panic? Is that really what we need to focus on?
I think that UK investors should really pay attention to inflation, not only in the US, but also domestically. And the reason being is that inflation is still a problem in the UK. It's true that the headline number has fallen below 2%, but core inflation remains around 3%. Wage growth is between 4 and 5%, depending on how you want to measure it, with or without bonuses. So, this economy, especially after the UK autumn budget and the implication on fiscal policies, is already prone to a reacceleration of inflation. But now that we have Trump as a president of the United States, well, inflation can rebound to a different kind of level. And the reason being is that what we have seen today is a very strong dollar, and a weak cable is inflationary for the UK. Basically, every kind of base metal or goods is commodity is priced in US dollars. So it wouldn't be weird once that Trump enters in the White House and imposes tariff to see, like some of these commodities rebounding and waiting on consumers. So the implication of inflation in the UK then has massive repercussions also with fiscal policies and monetary policies.
So,
And
so on
let's
that,
not,
Althea, sorry to cut
yeah,
across you, but
no, no worries.
immediately I'm thinking about tomorrow. We've got a big decision on the horizon, right, with the MPC, which is going to have a major impact on our mortgage pricing and savings rates. We all thought we'd slayed the demon of inflation. There'd been some data that had suggested it had popped down back into manageable levels. What's your sense about tomorrow? Do you think this result will have any bearing on that at all, or what do you think the Bank of England and the Monetary Policy Committee will stick to the long-term plan and perhaps keep edging rates downwards?
It's going to be very interesting what does the Bank of England does tomorrow, for the simple reason that they could ignite a second Liz Truss moment. In the meaning that you are having an inflationary UK budget, or a UK budget that maybe is not so inflationary, but it's definitely not resolving the fiscal deficit question. And on the top of that, you have an inflationary result in the US. And if you are perceived too dovish, so too eager to arrive to neutral rates, that might be bearish for bonds. So even if the Bank of England is cutting rates, if the market disagrees to that vision, the result will be higher gilt yields ultimately, and that's a huge risk. So I think that there is room for the Bank of England to deliver a rate cut based on how we have seen inflation to play out throughout 2024. But I also think that they should be very, very careful and cautious about their forward guidance. So probably they are not going to promise a regular cutting cycle, meaning back to back. Maybe they are looking at a more cautious kind of cycle, and probably with neutral rates to remain higher than what market expects. So probably there is room for cutting at this point of time, but is there room to cut below 4%? Thinking in a 12 months kind of period, maybe with the information we have now, probably not. And that's what is priced also in bond futures.
So Trump's going to make our mortgage more expensive, Ed.
Yeah.
Amongst other things.
To know. So I mean, there's a lot to think about there that goes way beyond just kind of pure markets, and as you say, Chris, about the kind of mortgages and stuff that affects people. Back on the kind of the investment side of things, I think the last period of Trump government, we had always pretty much a boom time in equities in particular, so for company stocks and that kind of thing. it was a bit of a different environment. We saw very low interest rates and that kind of thing. Althea, without asking too much of your crystal ball, because I know it's difficult, what do you see the kind of long term for kind of a Trump presidency and what that does to markets, and if there are any risks out there?
It's very complex in the meaning that Trump wants to implement pro-growth policies. And one of these pro-growth, two of these pro-growth policies are tax cuts and also the regulation. The problem with tax cuts is that you are going to have less inlays in the treasury. And it's not a given that growth will complement that kind of loss, in the meaning that you might need to wait a longer period for growth to pick up at a reasonable level in order to replace to offset those inlays that you're losing in the meantime. So everything links back to the fiscal deficits. And it links back also again to the bond market, because bonds are very, very sensitive to inflation and also the sustainability of the fiscal deficits. And if we arrive to a point that the bond market doesn't see value in US treasuries trading at 4.4%, 5%, or I don't know at which level, because of fiscal sustainability of debt and inflation, that could be a huge problem for Trump, because it means that investors will dump these securities, yield will rise, and at that moment he has to do something to stop that. So pro-growth policies, yes, they can be good for stock markets, especially because let's remember that we're talking about nominal growth, and that is reflected with the revenues of companies, and that basically includes inflation. But for the bond market is bad, and as yields rise, that's going to be a direct threat to the stock bubble. So I think that market dynamics are going to self-regulate somehow what is happening on the policy side of things under Trump.
I think, as you say, yeah, interesting to say the least for the next few years.
May you live in interesting times, eh?
Yeah, that's the word. I think we come back to that a few times now.
We have, haven't we?
Sorry, Althea, were you going to add anything else before we?
Yeah, but I think for investors, I don't want to deter investors out there in the meaning that this kind of scenario, it's exciting because it provides some risks and opportunities. And we have talked a lot about the risk. Where are the opportunities? And the opportunities out there is in the strong dollar. So basically, you would want to be invested in a currency that continues to perform well compared to your own. And that's why there still could be opportunities in that market, especially in the energy sector, banking sector, and so forth. And then really it's important to think about value preservation of a portfolio, because this is not the post-global financial crisis environment where yields and rates were collapsing. We are living in a place where inflation remains elevated, and we need to create a kind of buffer to protect our cash. And how to achieve that? Well, one way to do that is maybe to look at less risky investments that still provide a good risk-reward scenario. And I'm thinking about short-term bonds. So, and when I think about short-term bonds, I'm also thinking about gilts, not only US treasuries. Why? Because if you buy a 2-year gilts or US treasuries, well, you need the yield to rise to basically more than double before you start to lose money, considering a holding period of 1 year. So that's quite good it's quite a good spot where to park money, get some interest rate, which is, yes, eroded by inflation, but it basically gives you a pickup over inflation. And then as there is less volatility in markets, tries to understand where to deploy cash. And that is good, both gilts and US treasuries. I'm thinking also about gold. That has been one of the best performing assets we have seen this year, and is basically hitting new highs. It's true that rising yields normally offset a little bit the demand in gold, but this kind of rise in yields is unprecedented, is built not only on the expectation of inflation, but also on this huge deficit. And that's why traditional kind of safe haven might not work, and people would go to actually look at physical gold as a good hedge against the kind of macroeconomic backdrop that we are looking ahead.
Just and the last thing, actually, your mention of gold there reminded me to ask. I'm not sure what your views are on it, but Bitcoin hit an all-time high this morning, I see, on the back of the Trump win. Is that a digital gold we can rely on, or is it? I mean, what's sending that higher?
Don't get me wrong, I'm not a Bitcoin expert.
That's
but
fine.
the way that
We're not
I
asking
read
for expertise.
Just an opinion.
this is just my personal opinion.
Of course.
But I look at Bitcoin as a greed indicator. Okay. So when Bitcoin is going higher, there is a good reason to think that investors might want in the US to take on more risk. But in this case, particularly linked to the US election, we don't have to forget that Trump wants to be a pro-crypto kind of president. So the rise in crypto, I don't think that has any correlation like we have seen in the past few years with other asset classes. It might be purely correlated to the fact that Trump wants to be pro this kind of segment. Yeah. So, yeah, I think that it's not, I think I like to think about crypto in a diversified portfolio, maybe 5% kind of position there to offset some of the movements that we've seen elsewhere. But I wouldn't compare it to gold at the moment.
Of course. Brilliant, Althea. We've kept you chatting to us for a little while. It's been really, really insightful.
Absolutely.
It has been very nice talking to you, and I'm looking forward to the next time.
Absolutely. I'm sure we've got many more market episodes coming up that we could definitely get you back on to read the runes for us a little bit. But with that, I'll say we're going to continue here now just to talk a little bit further on some of the more personal financing things. But Althea, thank you so much for joining us.
Thank
you very much to you both. Bye-bye.
Bye now.
Bye-bye. So, Chris, I think there's some really interesting stuff to unpick there, and Althea's obviously really got finger on the pulse. And the main thing for me is the scary thing. I think is how it's all connected. How somebody in Pennsylvania voting for Trump can lead to you and me having to pay more expensive mortgages.
Yeah,
worrying, isn't it?
Yeah, it is. We're all in this gigantic global capitalist web, aren't we, Ed? And that, it's interesting because you do have skin in the game from a political standpoint. I know this isn't a political podcast in terms of what your views are and how you think about it, but we all, whether or not you do have strong views or not, you definitely will feel the impact of this, particularly with America being such a global economic powerhouse and a driver of the Western world in many ways, politically, culturally, but also economically. And so, much of the UK's growth prospects and our economic policies are intertwined, and that is going to have an impact on you and I's pocket, as we found out with the budget last week. So it's interesting because everyone kind of thinks that Trump is, he's won on this economy ticket, that he's great for the economy. But I think serious investors are while they'll welcome probably the deregulation thing, and there will be winners and losers he meant, Althea mentioned things like Elon Musk, who's obviously positioned himself on Trump's side, is likely to become out as a big winner here, and I'm sure we'll see movements like that. There does seem to be, in what she was saying, some jitters around what he's going to do and the lack of predictability. And usually these guys who are managing huge sums look for stability. And while insecurity can provide opportunity if you can identify it, for the likes of me and for the likes of you, who have got a relatively diversified portfolio, mine's held in funds, with some US exposure, European exposure, UK exposure, I'm hopeful that will be enough for me to come out on the upside of any of this, and I'm sure that will be the case. These short-term things are quite interesting in terms of speculation. The Bitcoin conversation was really interesting to me there because it has hit an all-time high. For my sins, I hold a wee bit of Bitcoin with some friends of mine, and I was probably going to sell it about 6 months ago. I'm pretty glad I didn't now. And there's a conversation about whether Trump being pro-Bitcoin is going to push that a little higher, so that's good. And you can speculate on all sorts of other outcomes, gold and other things like that. But actually, what I'm looking for is kind of slow and steady wins the race over a longer period with my investments. And so I'm not going to panic. I'm going to stick with the old moniker, time in the market, not time in the market, and watch how this plays out. But others who are in the position to do so may feel that they want to try and take advantage of what is essentially a new political and economic backdrop. Where are you at with it?
Yeah, I mean, I'm kind of not going to heavily react to what's happening. I think there is obviously going to be an impact. To try and discern that one way or the other is difficult, to say the least. I will at this point say put the risk warning on the podcast.
Please do.
Obviously, talking about all this investment stuff, it's complicated and people need to do their own research. And we're obviously not providing advice here. And anybody who needs to make decisions should potentially consider consulting a registered professional on this. In terms of my own, investments, I mean, I have very diversified, hold it in funds, just, broad this and that. I'm not going to change anything. I just leave it alone. I am actually probably more worried about the fact that I have to remortgage in 2027 at this juncture, although I've still got a couple of years to run on that. But who knows where we'll be in a couple of years, my single biggest asset is my home, and through paying my mortgage off a bit and prices going up, as they do, that is probably the most wealth I have. It's probably worth more than my pension now, even though my pension I've been contributing to since 2016. But I think I started my pension quite late because I used to be self-employed before that, and I just didn't bother. But such is the way that the mortgage, and property market works. It's gained a lot of value in not huge amounts of time. And am I going to be able to stomach a big increase in 2027? Well, that does play on my mind because I've got a kid and I've got a dog who has itchy ears all the time and has to go to the vet and that kind of thing. But without wishing to go on a political diatribe here, I think one of the big takeaways for me in all of this with the US election is Trump focused so heavily on, do you feel better off now than you did 4 years ago? And I think the simple answer is that we're seeing, because he's won the popular vote by quite a long way, despite everything and all of it, on that message. Because people don't feel better than they did before. And there was a lot of chat this morning on the radio and TV and that kind of thing about it's been a bad year for incumbents. Labour's got in here. Rishi Sunak has been punished for inflation. You look at France, Macron was punished for inflation. South Africa, the ANC lost their majority for the first time ever. This is so far and above us talking about personal finance, but the one big trend is that people don't feel better off at the moment, and that's going to cause earthquakes.
Yeah, it's a macro situation, isn't it? I agree. We don't. We talked about on the budget podcast, there's been no real growth in the UK economy since 2008. That's going to impact job prospects. That's going to impact wages. That's going to impact, monetary policy. And as we've seen, there's been an inflation spike recently. And, I think taking a more sort of aggressive tone on it, maybe some of those incumbents deserve to be punished for being asleep at the wheel. I don't know. You could have to take each one in its own with its own merits. But it just feels like since 2008 there have been some real inflationary pressures baked into this for quite a while, and maybe we celebrated its demise too soon, and actually, more uncertainty in what is becoming an increasingly uncertain world is going to lead to people not being entirely comfortable with the money in their pocket and having to keep an eye on all sorts of different factors. And that's where hopefully, conversations like this can help, where we can bring that to light and everyone can keep an eye on the levers they need to pull or not, as the case may be. I've been through the remortgaging thing, as we talked about earlier this year, and I'm feeling that pain right now. And it has a major impact on my family's collective bargaining and buying power. They have to have some harsh conversations, particularly when you're mixing things like childcare and everything else like that. And I'm trying to take a long, medium and short-term view on all of this. But actually, if the mortgage comes in higher than you think, all that other medium and long-term thing kind of goes out the window, particularly when it comes to sort of, wages not going up in a long period of time. I'm not talking about my own situation. I'm talking generally, other people who are having to make some tough decisions about how they cut their cloth. So the idea that this was all going to sail gently on after, inflation came down to its more manageable levels perhaps was a little bit fanciful. But I do think it will tick down. Like anything, there's a bit of a shock with these things. We might see a little bit more short-term volatility, and then hopefully they'll get down to business. And if the American people were right who voted for the economy and he's going to be a major driver of its uplift, then that will have a knock-on effect for us, putting aside any political leanings. Hopefully that will have a positive knock-on effect. And as I think I saw someone posting on LinkedIn, don't let your politics make you poorer. That seems like good advice to me in terms of, well, what is the reality of the cards that we've been dealt here and how best to position ourselves when it comes to all of it: pensions, investments, savings, having that rainy day fund, and making sure that you're watching what mortgage rates are doing so that you can manage a big asset if that's what you're doing, or if you're saving, what the house prices are likely to do off the back of it. So we're all in this big economic soup together, Ed. That's my takeaway, and we've got to see which parts we need to monitor.
So before we finish, and we have mentioned it a little bit, there is a new bank rate decision coming tomorrow, and I think, well, I mean, I don't know what you feel about it, Chris, but my sense of it is that this throws a bit of spanner in the works potentially, especially if
Hang on, are we going to eat our hats here? Is this another hat? Did you eat your hat last time?
I'm about to make a hat sandwich for you, Chris.
I didn't see you do it. Maybe I'll have to enforce that if I win.
I refuse to eat my hat. I agreed to do something else. I can't remember what it was now. Let's forget that and move on. But
okay, that's convenient.
Okay, so my prediction. Actually, I'm going to ask you. What's yours first? What do you think?
I think they'll forge ahead with a cut. I think they need to send the message that the plan is working. But what was interesting in what Althea said was, but they might need to be a little bit more bearish, which means sort of cautious in their forward guidance. So before, I think they were giving signals to the markets and everybody else saying, there's more to come. Don't worry, this is on the way down. I think what they'll say is, we're going to cut now, but actually there's no guarantees. We have to watch the situation now, which might create more fear, uncertainty and doubt, or it might assuage people enough to feel that they can carry on getting on with their business because life has to go on. What do you think, Ed?
I do think they will probably cut. I think it'll be a small one. I think the temptation would be for them to hold. I think they actually meet today, so they'll be watching it and making a decision right now, which is fun.
Strong coffee, having been up all night. Or do you think they just roll in with the results? What do you think?
Yeah,
how do you think they go about it in the Bank of
England? I think the fact that the Trump's not actually starting until January will, have an effect because
that's true. It's a good point.
Enacting anything for another few months. I think the fact that UK inflation was actually lower than expected.
Was it 1.7 or something? 1.8?
Yeah, it was under 2, which, it was, I can't remember the specific number now, but it was under what was expected. And that particularly came out of things like, petrol prices. And we've certainly noticed it as people who, I drive my car nearly every day. Petrol came down precipitously in the past couple of months. And I think, I don't know. I agree with Althea though that they are ultimately probably going to want to keep a bit of powder in the chamber, basically, and that means probably settling at a slightly higher ultimate, medium-term level. because basically they're just watching out for the day when everything starts throwing a hissy fit and they have to slash rates. The problem is if you start cutting beforehand, then you don't have a lot of cutting you can do if and when, you know, the proverbial hits the fan. So we shall see. I don't envy them.
No, it's a hard call, isn't it? It is a hard call, in fairness. I know we do like to come on here and have a go at some economic and political figures from time to time, but that is a tough call.
Yeah, I like being a fence-sitting pundit. All of the opinion and none of the responsibility. It's great. But yeah, I think that about wraps it up. We shall see what happens. We'll see if we're eating hats next week on the podcast. Hopefully not. It will be collective because we've landed on the same result. So with that, Chris, thank you very much for joining me.
My pleasure.
And thank you everybody for joining us. We'll speak to you again soon. Thanks for that, and goodbye. Don't forget to subscribe to the show on Spotify, Apple Podcast, or YouTube. You can also follow all our latest updates on TikTok, Instagram, or X. Finally, check out all our money stories on the Mouthy Money website and subscribe to our weekly newsletter for all the latest straight to your inbox. Thank you and goodbye.